Hi there guys, how you guys doing? It's Isaac Easy once again, and we're doing introduction to price action. So this is our beginner course, online course. This is our beginner course. So I'm going to be taking you through introduction to price action. I'm going to be taking you through candlestick patterns. I'm going to be taking you through the Nasdaq beginner strategy. So let's get straight to it. What is price action? Price action trading is a methodology for my financial market speculation, which consists of the analysis of basic price movement across time. Put simply, price action is how price changes over time. Price action trading ignores the fundamental factors that influence a market's movement, and instead it looks primarily at the market's price history, and that is to say its price movement across a period of time. So as price action traders, we say we look at raw data from the chart and then we make our speculations from there. So in other words, price action trading is a pure form of technical analysis, since it includes no second-hand or price derived indicators. So price action traders are solely concerned with first-hand data a market generates about itself. It is price movement over time. So here we're going to talk about a few price action patterns. So the first one that we're going to talk about is an inside bar pattern. An inside bar pattern is a two-bar pattern consisting of the inside bar and the prior bar, which is usually referred to as the mother bar. The inside bar is contained completely within the high to low range of the mother bar. This price action strategy is commonly used as a breakout pattern in trending markets, but it can also be traded as a reversal signal if it forms at a key chart level. So as you guys can see over here, it's that is an example of an inside bar pattern. All those three there. Those can be used as a reversal signal or can be traded as a breakout pattern in a trending market. Okay, two, we have what we call a pin bar pattern. A pin bar pattern consists of a single candlestick, and it shows a rejection of a price and a reversal in the market. The pin bar signal works great in a trending market, a range bound market, and can also be traded counter trend from a key support or resistance level. The pin bar implies that the price might move opposite from the direction the tail is pointing, as it's the tail of the pin bar that shows a rejection of a price and reversal. As you can see here, the tail, others may refer to it as a wick. So if we have something like that, then we know it is a rejection. Then we go in the opposite direction. Similar here, and then similar to this one, a bullish pin bar. If we have that tail pointing to the downwards, then we know we are expecting to go up. Okay. So here again, we're still talking about introduction to price action. So here we're going to talk about support and resistance. Okay, the concept of support and resistance is very important for traders. Support and resistance are key areas in the market where price will reverse or break to continue the move. Support and resistance lines are similar to trend lines, but they are drawn horizontally. They are very important key levels that tell us about a certain price point that are respected by the market. Broken support becomes a resistance, and broken resistance becomes support. Each time an area of resistance is broken, the market will retest that area and it becomes support, and vice versa. How do you see the difference between a valid and a fake breakout or fake outs? Obviously with a retest. If there is no retest, there is no entry, it is a false breakout. So here we have an example of how to draw your support and resistance. So looking at figure 3 above, the red arrows show support, which is the area where the bearish market or the downtrend failed to break, so it bounced and reversed. So the green arrows show resistance, which is the area where the bullish market or the uptrend failed to break, so it bounced off and reversed. Broken support becomes resistance, and broken resistance becomes support. So once the market breaks support or resistance, we expect it to retest and continue the move. So as we can see here, that will be our resistance and that will be our support. And we can see there was a breakout of the support and the market retested it, so it turned that into a resistance. So we see we retested, so if we were to break then retest, we will take a sell and then go down with the market. Then we see here there was a rejection when the market hits your support and then it continues moving back up again. And then same thing here, there was a rejection, the market hit your resistance and then it continues going down. So if it breaks and go to the upwards, then this turns into support. Okay, so one may ask how to draw support and resistance. To draw support and resistance, you need to join two peak points by drawing a line across them. The line can be horizontal, ascending, descending, or depending on the direction of the market. So you need two key areas that are connecting to each other, like same like here and there. Then we have more. Then we see that this is where the market usually reverses. Okay, so candlestick patterns, I'm going to show you other candlestick patterns. There are a lot of different candlestick patterns. When traders recognize these patterns on the chart, they act accordingly. Traders examine candlestick patterns through the visual analysis of the charts. There are two main types of candlestick patterns: reversal patterns and continuation patterns. As it's evident from these names, they show the probability of market changing direction. So let's look at the reversal patterns. Reversal patterns are candlestick formations that tell us the market is about to reverse or change direction. The pattern can be formed by two or more candlesticks. They indicate the high odds that a trend will change direction or make a deep correction. These patterns help to identify possible entries points at the beginning of a new trend or big counter trend move. So if you can look at this here, these are the different types of your candlestick reversal patterns. Alright, so first off, we'll have a bullish engulfing pattern. A bullish pattern is where there is a lot of momentum in favor of the price rising. Right, so this shows you that the buyers have more momentum than the sellers, and if you see such a pattern, then we know we continue going up. And then we have a bearish engulfing pattern. A bearish engulfing pattern where there is a lot of momentum in favor of price falling. So that means, as you can see here, your sellers have more momentum than your buyers, and this will usually happen at your resistance area. So if you see such a pattern, then you know we are continuing going down. Harami is a neutral pattern where price is being pushed into a tighter range and will break out soon. Okay, and then we have a dark cloud cover. Don't pay attention to that for now as a beginner. And the rising sun, those you can learn as time goes by. Let's move all the way to our hammer of pain. This is a signals a reversal where the wick sticks out way past the surrounding prices. Actually, we have spoken about that already, where the price rejects and then we go in the opposite direction. Same here, the market price rejects and then we go in the opposite direction. Okay, so you will learn the other ones as time goes by. The other ones are included in the advanced course. The continuation patterns, we're not going to talk about them now. Okay, so let us go to other patterns. So the patterns that we're going to talk about here that are most importantly, especially when trading Nasdaq, is your double top and your double bottom patterns. The double top and double bottom patterns are usually found at the end of an uptrend